The financial system is more fragile than you think. Most people believe the financial system is stable because it looks stable. Banks open every morning. ATMs work. Markets recover after every crash. And governments repeat the same phrase whenever fear spreads. The system is resilient. But history tells a very different story. Because the truth is, financial systems don't collapse loudly at first. They weaken quietly. Stress builds in places most people never look. And by the time the headlines change, the damage is already done. Right now, beneath the surface, cracks are forming again. Not in one country, not in one market, but across the entire global financial system. And what makes this moment especially dangerous is that it feels familiar. Yet the tools to fix it are running out. Let's start with the foundation. Debt. Debt is the fuel of modern economies. Governments rely on it. Corporations depend on it. Households are locked into it. In moderation, debt helps growth. But when it grows faster than income, it becomes a trap. Today, global debt is at record levels. Higher than before the 2008 financial crisis. Higher than during the pandemic. Higher than at any point in history. Governments borrowed aggressively to survive emergencies. Corporations loaded up during years of cheap money, and consumers stretched themselves just to keep up with rising costs. The problem isn't just the amount of debt, it's the price of debt. For more than a decade, interest rates were artificially low. Money was cheap, risk was ignored. That era is over. Central banks raised rates at the fastest pace in modern history to fight inflation. And while inflation has slowed, the consequences of those hikes are only beginning to show. Higher interest rates don't break systems instantly. They apply pressure slowly, like tightening a vice. Governments now face soaring interest payments. Some countries spend more servicing debt than funding healthcare or defense. Corporations that survived on refinancing cheap loans are discovering they can't roll over debt without massive losses. And households are watching mortgages, credit cards, and student loans consume more of their income. This is how fragility grows, quietly, unevenly, and invisibly. Now let's talk about banks. Banks don't fail because everyone withdraws money at once. They fail because confidence disappears. Banks operate on trust. They take short-term deposits and invest them long-term. That system works, until it doesn't. When interest rates rise sharply, the value of long-term assets falls, and suddenly, balance sheets that looked strong start to crack. We've already seen what happens when confidence breaks. Regional banks collapsed not because they were reckless gamblers, but because they were exposed to risks the system pretended didn't matter. And those risks haven't disappeared. In fact, they've spread. Commercial real estate is under severe pressure, especially in major cities across the US, UK, and Australia. Office buildings sit half empty. Property values are falling. Loans written during low-rate years are coming due in a high-rate world. Losses are inevitable, and banks are exposed. But here's the deeper issue: concentration. The financial system today is more interconnected than ever. A small number of institutions hold enormous influence. When stress appears in one area, it doesn't stay contained. It moves through derivatives, funding markets, and global capital flows. This is why central banks panic even over small failures, because they know the system is tightly wound. And that brings us to the most dangerous illusion of all: the belief that central banks can always save the day. For years, the solution was simple: print money, cut rates, inject liquidity. Markets learned to expect rescue. Risk-taking was rewarded. Discipline disappeared. But today, central banks are trapped. If they cut rates too soon, inflation can return. If they keep rates high for too long, debt breaks the system. Every decision creates a new problem. This isn't strength. This is fragility disguised as control. And here's the uncomfortable reality most people aren't told. Financial systems don't collapse because of one event. They collapse because pressure builds everywhere at once, until something snaps. And right now, the pressure is building. In the next part, we'll look at where the next shock is most likely to come from, why markets may be underpricing risk again, and what this means for everyday people, not just investors or banks, but anyone who depends on the system to work. Because when fragility turns into crisis, it doesn't stay on Wall Street. It reaches everyone. The next shock won't come from where most people are looking. Markets are obsessed with inflation numbers, interest rate meetings, and stock indexes hitting new highs. But financial crises rarely start at the center of attention. They begin at the edges, where leverage is high, transparency is low, and confidence is thin. One of those edges is sovereign debt. For decades, government bonds were considered risk-free, the safest asset in the world. But that assumption only works when investors believe governments can always borrow cheaply. That belief is being tested. As interest rates stay elevated, governments must issue new debt at higher costs. Investors are demanding better returns. Bond auctions are becoming more fragile. And when yields rise too fast, something dangerous happens. Existing bonds lose value, pension funds wobble, and funding costs ripple through the entire economy. We saw a warning shot in the UK not long ago. A sudden spike in bond yields nearly broke pension funds using leverage. The system didn't fail, but only because emergency intervention stepped in at the last moment. That wasn't a fluke. It was a preview. Another pressure point is shadow banking. This is the financial system outside traditional banks, hedge funds, private credit firms, money market funds. These institutions manage trillions of dollars, often with less oversight and higher leverage. They promise higher returns in a world desperate for yield. The danger isn't that shadow banks exist, it's that they're deeply connected to traditional banks. When stress hits shadow lenders, losses don't stay hidden. They move into the core system, through loans, derivatives, and liquidity demands. And unlike banks, many of these entities don't have direct access to central bank support, which means when panic hits, exits disappear fast. Then there's the consumer, the part of the system policymakers always assume will adapt. Households in the US, UK, and Australia are under pressure from every direction. Higher mortgage payments, rising rents, expensive food and energy. Savings built during the pandemic are fading. Credit card balances are climbing again. This matters more than markets want to admit, because consumer spending is the backbone of modern economies. When households pull back, corporate earnings suffer, jobs weaken, defaults rise. And suddenly, what looked like a soft landing turns into something harder. The system depends on confidence. Confidence that people will keep spending, borrowing, and investing. Once that confidence cracks, the feedback loop turns negative. And here's the most uncomfortable truth of all. The system today isn't designed to absorb shocks. It's designed to postpone them. Every crisis response has added more complexity, more leverage, more dependence on intervention. Problems are pushed forward, not resolved. That's why each cycle feels larger than the last. This doesn't mean collapse is guaranteed tomorrow. Financial systems can limp along longer than logic suggests. But fragility means outcomes become more extreme. Small mistakes create big consequences. Minor shocks cause outsized reactions. And when the break finally comes, it won't look like a movie scene. No alarms, no countdown. It will look like confusion. Markets swinging wildly. Emergency meetings behind closed doors. Officials insisting everything is contained. And then, suddenly, rules change. Capital controls, bailouts, forced mergers, liquidity freezes. History shows that when stability breaks, speed matters. Those who understand the system early have options. Those who don't are left reacting. This isn't about fear. It's about awareness. Understanding fragility doesn't mean predicting the exact moment of crisis. It means recognizing that risk isn't gone just because markets are calm. It means questioning comforting narratives. And it means preparing mentally for a world where the financial system isn't as solid as it appears. Because the most dangerous assumption you can make is believing that what worked before will always work again. If this kind of deep analysis helps you see the bigger picture, beyond headlines and market noise, make sure you support the channel. Subscribe, share this video, and stay with us. Because understanding how the system really works isn't just interesting anymore, it's necessary.